Hello and welcome to today's RIMS webinar, Alternative Risk Transfer, How Bermuda's Regulation Keeps Pace with the Developing Risk Landscape, sponsored by the Bermuda Business Development Agency. This session will be moderated by Sarah Demmerling, a partner of the Corporate Financial Funds and Insurance Group at Walker's Bermuda. My name is Justin Smollison, Business Content Manager here at RIMS, the Risk and Insurance Management Society. All downloads and contact information will be accessible to the sponsor. On with today's presentation. Today's experts will explore Insurance Linked Securities, ILS, and how the development of Bermuda's insurance legal and regulatory framework provides an attractive platform for ever-changing market conditions and the evolution of alternative sources of risk. RIMS is thrilled to welcome a huge global audience, and now I will hand it off to our moderator, Sarah Demmerling.
Thank you so much, Justin. Thank you for having us. Thank you to the Bermuda Business Development Agency for facilitating today. We're delighted to be here. Thank you so much to the audience. I know we've all got webinar fatigue, so we will do our best today to keep it lively and keep our panelists on their toes. We've got a great discussion. Before we begin, let me introduce our panelists. We have Tejan Talbot, Principal and Alternative Capital Specialist at the Bermuda Monetary Authority, responsible for the supervision of alternative capital insurers. He will bring the regulatory view to today's discussion. Next, Nicholas Plianthos. Nick brings a perspective from the insurance manager side. He is Senior Vice President at Marsh Management Services. He leads Marsh's ILS administration services in Bermuda and is the client executive for a number of Marsh-managed insurance companies comprising captives, commercial insurers, and special purpose insurers. Next, Martin Burke. Martin brings important insight as to what he is seeing from the market investor perspective. Martin's been a member of Mount Logan Re's board of directors since 2018 and serves as the company's chief financial officer. Mount Logan is the risk securitization vehicle for Everest Re. It allows capital market investors access to diversifying reinsurance risk premium. As Justin says, we welcome questions. We will try to deal with those at the end of the session, which we're thinking will take about 45 minutes. So let's jump in. Today, we're discussing the alternative risk transfer, and in particular, how Bermuda's insurance regulatory regime has aided the development of alternative risk transfer, and how it's at the forefront of a rapidly evolving risk landscape. Traditional reinsurance markets have fully embraced third-party capital in the last decade. The ILS sector has emerged as a key capital market and added significant capacity to traditional risk transfer in a variety of ways. From cat bonds to collateralized insurance to sidecars, ILS is continually evolving, adapting, and growing in record numbers. So Tejan, if I can start with you, how has the ILS sector developed in the last 10 years?
Thank you, Sarah, and thanks for having me today. So from a regulatory perspective, there's certainly been, a large number of occurrences in the market that have happened over the last decade. So I'll try and pull out sort of the biggest key elements. I feel like my grandfather about to tell a story, but so 10 years ago, the Bermuda insurance ILS framework was fairly immature. When you think of the introduction of the special purpose insurer class, that was only in 2009. So 10 years ago, that was 2 years old. The products that we were seeing placed in the market at the time were very specific in timing and seeding, and really non-complex. Examples are like the 1448 cat bond issuances. So at that time, it was very sort of introductory and sort of immature. Fast forward a bit to about 2012 to 15, this is where we started to see a bit of sort of the capital scaling into the market, the Bermuda market, and then the market globally. Between 2013 and 15, we registered approximately 99 new SBIs. So that was a number of new capital and returning capital now entering the market. Shortly after this scaling phase, around 2017, this is where we started to see the shift in evolution. The capital became long-term strategic capital. Collateralized insurers became sort of the predominant structure. And with that came a number of increased risk appetite. So for example, new lines of business, increase in appetite for contractual terms, and really bringing a lot of influence into the reinsurance market. We know 2017 was a pretty active loss year. Estimates say Bermuda, paid losses at roughly 30% related to Harvey, Irma, and Maria, and ILS was certainly a big player in that the market's ability to make those payments. And I think, as we see today, the market, the way it's evolving, much of this stems from that early evolution and things just continuing on. Maybe Nick or Martin might be able to give a bit more color around those pieces, and then we can just come back and discuss how that's influenced, the ILS framework and a lot of the wholesale changes that we've had to make as a result. So Nick, maybe you might have some further perspective.
Yeah, thanks, Tejan. Maybe just to give some more context in terms of numbers, since 2009, Bermuda's registered obviously a number of companies, from captives to commercial insurers to life companies. But of all those registrants, 40% of them have been in the ILS space. So that's special purpose insurers, and more recently, the new class of insurer, which is the collateralized insurer. Some more facts and figures. In 2009, there was about 14 billion outstanding in the cat bond market. We've now got 52 billion outstanding in terms of issuances. So the capital in the ILS space has really grown significantly. And as a result of that, and some of the points that Tejan already raised, the framework that the BMA has put out there from a regulatory standpoint has evolved with that growing capital. We've also seen a number of insurtechs now come into the ILS space, and with the increasing focus on items like ESG and climate change, the evolution is not going to stop.
Thanks, Nick. And I think the numbers are great. And when you talk about the 52 billion that we are currently on the BSX, we now have listed issuers representing about 95% of that marketplace. So Bermuda really does have a big hold and an understanding of the space. Martin, did you want to add anything before we hand back to Tejan to maybe dig a little bit deeper into recent enhancements?
Yes, thanks, Sarah. And I'd echo Tejan and Nick's comments. I would think, what we're seeing in the market is also the education of investors, as well as from the ceding side, looking to securitize risk. So we have the investors come in, as Tejan said, initially in the late 90s with the first cat bonds, and mostly cat bonds, and then it accelerated in the last 10 years into collateralized re and other lines. And we're seeing investors, get more comfortable with the insurance risk. And we're also seeing cedents stand on the other side looking to securitize, more ground up risk and reduce that basis risk that's kind of inherent in the cat bond product. And I think we're seeing the Bermuda Monetary Authority in the market is doing a great job to kind of evolve the regulatory landscape to kind of accommodate that appetite from the investors, and I'd say from the market. It's really helping the market kind of grow and provide the right capital against the various risks that they assume.
So thanks, Martin and Nick, for your color added to sort of this timeline. Now, if I just jump back to 2017, and we talked about the evolution and the scale at this point in time. It was at this time where the authority took a stronger focus on ILS. The initial phases of introducing the ILS market and building a framework sort of had fastly become a bit outdated. So there were some enhancements that we felt needed to be made in order to keep abreast of what has developed in the market since. The first sort of addition to the framework was 2017, when we introduced the alternative capital filing schedule. So annually, we collect data on a contract basis for each of our alternative capital insurers. This provides us with market surveillance and as well as a market and being significant in sort of the ILS space as a jurisdiction, we can provide market transparency globally. And of course, this is also a great supervisory tool as we go through our day-to-day supervision of these structures. But also this data, along with a bit of robust consultation with the market and really teasing out some very topical issues, which most of you will sort of be well aware of. Between 2018 and 19, there was a robust consultation period. And we had a great deal of back and forth conversation about topical issues and their emergence, and then the expectation, of the BMA going forward, and how, we see the most prudent and pragmatic manner in which ILS should operate within the jurisdiction. The results of this was 2019, we introduced the collateralized insurer class. And the basic premises of this class was to introduce a framework that could accommodate the growing complexity of ILS business models. Shortly after that, in 2020, we enhanced the special purpose insurer guidance note as the evolutions, brought out a lot of topical issues. And just to be clear from a regulatory perspective on the standards and how, special purpose insurers should operate on elements such as, what is the definition of collateralization, for example, the ability to either use or not use reinsurance, and different other contractual terms that had emerged over time. So the guidance note was issued to enhance our views from 2009 when we introduced the special purpose insurer class. And in addition to that, we also developed some specific filing requirements for the special purpose insurer and the collateralized insurance class, recognizing, of course, these business models are nuanced and sort of don't follow the same beat as our traditional market. Therefore, we felt it prudent to introduce, specific filing requirements for these classes. I think overall, we saw a great deal of change in a short amount of time. The BMA sought to sort of be responsive and ensure that we're applying prudency and policyholder protection as these evolvements go along. So the enhancements were deemed necessary. And I think going forward, there will be a continued focus on, a solutions-based framework that provides not only prudency, but an environment where the evolution and innovation, can thrive.
Thank you so much. I am going to put you on the spot. You talked about the enhanced SPI guidance note. Mm-hmm. And then with the new class, obviously there's been discussion about what that guidance framework document might look like. Could you give our audience any exclusive updates as to when the BMA might be thinking about releasing the CI framework document? Yeah,
so we're actually working on a document not only for the collateralized insurer class, but a document that will help stakeholders and potential stakeholders navigate the entire ILS framework. We have a full gamut of classifications that can facilitate various ILS business models. And that document we do anticipate putting out closer to the end of the year. We're wrapping up some of the consultation pieces and feel the end of the year would be an appropriate time to have that published.
Fantastic, great news, thank you. I want to delve a little bit more. We're talking about the SPI, the collateralized insurer, about what are the differences between those. But Martin, Nick, did you have anything that you wanted to add before we move there?
No, that's fine, Sarah.
I think we can move on, Sarah.
Okay. So maybe Tejan, staying with you, we created the SPI in 2009. We now have kind of three classes. We have the restricted SPI, the unrestricted, and the collateralized insurer. Could you just give us kind of a high level overview of what the difference is between each one?
Yep. So high level and as basic as I can make it. Quite a challenge, but I'll give it my best. So if we think of the three classes, really what we've done by introducing these three classes is provided a framework for the spectrum of ILS business models. So not every structure looks the same and operates the same. Therefore, a segmented approach was deemed most appropriate considering what we have in our market. So if we focus on the actual business models, this might sort of better draw the picture on how the classes sort of benefit the various business models. Looking at the restricted special purpose insurer first, the business models that we typically see in this space are those specific deals with a name ceded over a defined period of time, such as a cat bond, and very similar to those deals we saw in the early stages. The key elements of this framework is sophistication of the participants, and in this case, particularly the cedants. So for a restricted special purpose insurer, that registration license will come with a condition that restricts their business to a name cedant on their license, so that specific deal with a specific cedant. Looking at sort of collateral and the investment of collateral, the collateral is held in a trust to the benefit of the cedant. Also, the collateral, if it's invested, is in low risk, high quality assets. So typically in practice, what we see is cash, money market funds, and things of that nature. And then the next element will sort of be the contractual certainty. So the contracts are meant to be explicit. And once the deal's put in place, the contract really determines how the deal will respond in various scenarios. So how does the deal respond in a loss event? How is a loss triggered? Who determines a loss? Right on up to the return of capital and how that mechanism plays out. Jump to the unrestricted special purpose insurer class. Very similar, however, the key nuances here is that the business model is multi-deal, multi-participants, and in certain cases, unknown. So for example, when we assess sophisticated participants, the requirement remains with the unrestricted special purpose insurer. However, how it plays out is slightly different. So these insurers will have a restriction on their license that draws out a parameter in which determines who they can conduct business with. So for example, that could be, only rated cedants of a particular rating for that matter. And that's how we maintain sophistication, but also bring in parameters for which this particular, unrestricted model will work. As well, the collateral elements sort of remain the same. So there's very much similarity between the restricted and unrestricted special purpose insurer in that regard. The contractual certainty also remains. However, the only difference here is a slight bit of operational risk increase as there's multiple deals. So, you could have cat bonds, cat quotations, excess of loss contracts. However, that requirement to have contractual certainty still remains. There's just the operational element that there's multiple contracts with multiple cedants. And then the duration of these vehicles tend to be for a longer period as, they're taking on multiple contracts. Then we jump to the collateralized insurer class. As I mentioned earlier, this is really to supplement the framework for the special purpose insurer. So these take into account the most complex ILS models. So things such as, increased appetite for more complex lines of business, the introduction of operational risks, in other words, stronger contractual terms, multiple deals. And when I say multiple, I mean even further beyond what we see in the restricted special purpose insurer class. Then there's an element that affords, market risk beyond what we see in the special purpose insurer class. So the investment scope can be a bit wider than those, low risk, high quality assets. And then the third element that makes it different is the credit piece. So there's a credit element that's allowed, and primarily looking at things like reinsurance counting as, part of the collateral. And all of this is supplemented with a capital model, which is built specifically for collateralized business. So once again, it differs from the traditional BSCR capital model. There's a model that's built specifically for the CI and takes into account that enhanced operational, market, and credit risk that's afforded within the CI class. So at a high level, those are the differences. But the key things to remember is at its core, the business is technically the same. When we jump to the definition of fully collateralized, that's really where we start to see some differences, especially between the SBI classes and the collateralized insurer classes.
Thank you. That's very, very clear. Nick, maybe if you could jump in here, I'd be interested to hear your thoughts about the new class. Do you see it as a competitive advantage? What's your thoughts on the new CI class?
Yeah, I think it is a competitive advantage, and that's kind of evidenced by the fact that before the BMA even finalized their framework around the license, they had gone and registered a collateralized insurer. So clearly the market was aligned with the BMA, and that this new class of license was warranted. Now, as Tejan has said, we had our special purpose insurer license developed back in 2008. And if you look at some of the new domiciles who are now trying to get into the ILS space, they're still trying to emulate our special purpose insurer license. Meanwhile, we've evolved from there to now, introduce this new CI license, which sits nicely between a special purpose insurer and a full-fledged commercial insurer 3A license, which is a lot more regulatory oversight and regulatory capital required to operate in that space. So I definitely think the CI license is a competitive advantage for Bermuda.
I think that's an important distinction, that the restricted, unrestricted SPI and the CI that Tejan was mentioning, they're all limited purpose insurers. They don't get into the commercial landscape. So there is still flexibility there. So maybe, sorry, Tejan, picking on you, from a market perspective, what's been the response? What motivation are you seeing for those choosing to register as a CI, collateralized insurer?
So for the CI class, we didn't expect some great explosion of, CIs popping up, but we have seen some momentum. The market does have a place for those more non-complex structures, and they do remain. However, as we mentioned, this is for the more complex vehicles we're seeing. So we're gaining momentum, and I think the initial adapters were those that look to change class. So, maybe they might have been subject to the commercial regime, which doesn't speak directly to those business models. But at the time, that's what we had that was prudent to supervise those business models. So we had some early adapters that, changed in class, and even some SBIs, for example, that wanted to step up to take advantage of those increased flexibilities and, develop further the business models. So they had the capital behind them to think more futuristic. Then there are some, new capital that's come to the market, and maybe the business model hasn't developed there, but they're starting off in the CI class with sort of a forward-looking view to exercise those flexibilities and increase the ability of what they're able to offer their clients. So that's really what we've seen so far that's come into the play for the CI framework. There's a lot of conversation that goes on, a bit more than we typically see in the SBI space, as it's a bit more consideration. And this is where we talk about that, long-term capital strategies. So therefore, there's a great deal of background work that goes on before these vehicles actually come to the market. So I will say that, they tend to be slower to the market, but when they come, it's usually a big scale, big ambitious business model that we see. But the momentum definitely has picked up. As Nick mentioned, from the introduction of the framework, before we even got into the supervisory matters, we had some, strong interest and representation in the CI class, and that continues, to today.
Perfect, thank you. Martin and Nick, obviously, jump in as and when. Martin, maybe turning to you. I know Mount Logan it's a class 3. It's not a collateralized insurer, but you do have collateralized business. Can you maybe just talk to the benefits of collateralized placements for Bermuda?
Sure, and I'd echo Tejan's remarks about and Nick's about, when they introduced this class, it's kind of a solutions-based regulator, and I think that really helps maintain Bermuda's competitive advantage. Because when we look at regulation, we kind of think about it, you want fit for purpose, and by having that kind of suite of options, you get to pick the license. If you want an SPI and you're doing one listed cat bond, or you want to get into the collateralized space, as a collateralized insurer, it gives you that flexibility to either use collateral or use some of the credit exposure. So actually, Matt and Logan, we were probably a perfect example. As a class 3, we operated under the SPI license, and we've actually re-licensed as a collateralized insurer at the beginning of the year. So we will be one of those market participants who is, part of the task force and thinking about, how the license should work. And I think we feel it works very well. And again, thinking about the license, you want to capture the right amount of regulation. Nobody wants to be over-regulated, but you still need robust regulation so you avoid any bad actor issues. Everyone can have a trust in the framework. And I think the collateralized insurer license really allows the kind of the larger reinsurers to kind of, and manages to kind of fulfill the investor needs. So if investor wants to collateralize with some non-cash collateral, or if you want to use leverage, or if you want to go beyond property cat and have multiple lines, all that can be done in a collateralized insurer framework, but still in the framework of working with capital markets where you can take their capital and give back their capital after a period of time. Whereas if you want to stay more plain vanilla in the cat bond space, there's the appropriate regulation there, which would be a lower, kind of a lower risk perspective.
And yeah, just to interject quickly, I think one of the big advantages of the collateralized insurer is that it can transact with unrated cedents. So again, that just gives you a much broader landscape of potential cedents to work with, as opposed to the traditional SPI class, which is, with rated cedents only.
I guess I'll just underscore the comments that were made and just reiterate, that this class is supplemented with the appropriate regulatory oversight. There's a built fit for purpose, capital regime that goes with this class. It's pragmatic in that it focuses on the key risks, but it's also prudent in that, we have key supervisory metrics that will take on that added flexibility that's allowed in the class. And I think, between the consultation that's going on right now, we've found what is, from a regulatory perspective, a good sweet spot to ensure that we continue to, supervise these products appropriately. But also it's enough for the market to continue as things evolve in the market landscape.
Now, that's all great to hear. And, some people might have had reservations when it was first introduced, but I think clearly this is something that is being taken up and has obviously met market demand. And with the BMA's approach to collaboration and consultation, it really pays off when you're listening to what market participants are wanting and delivering. So that's great to hear. In terms of timing, Bermuda's obviously always been known as having speed to market. There recently is a new announcement for a particular class of cat bonds with the accelerated licensing process. Maybe Tejan, can you tell us about that?
Yep. So I think last month in August, we introduced the 3-day SBI cat bond / mortgage bond approval process, and that's for licensing and registration. And really, once again, this is recognition of, the spectrum of alternative capital insurers that exist in those business models. And here we have an opportunity with sort of the plain vanilla, non-complex business models to, increase our efficiencies with the market. So it's targeted towards the restricted SBI model that we talked about, particularly for cat bond issuances and mortgage bond issuances. And really what this is the BMA leveraging its wealth of knowledge and experience in this particular space over the past 10 plus years, licensing and registering these non-complex vehicles. Also, we've built up the expertise in-house to provide a keen focus on these particular applications. This doesn't necessarily mean the applications themselves are sort of the prudency that goes into them has been watered down. What it means is now we're able to segregate these applications outside of the normal process, which remains, pretty speedy. 5 days, you have your application in on a Monday and you get your response as far as licensing on a Friday. But now what we're seeing is we'll take it out of that general process and have a specified process for these applications. It adds flexibility. So these applications can be submitted on any day, not necessarily just a Monday. Also, it merges the two processes. So the licensing and registration process are typically separate. So this process actually considers the full gamut from licensing right to registration. So the end result is actually a certificate of registration, and the registrant can, begin writing business. When you think of the Cat Bond model, there's a large deal of upfront work. So these tend to be, ready to go business models. So it only made sense that, we merge those processes and develop something that, benefited the market, and particularly that segment of the market. Another tool we utilize is the checklist. And this checklist sort of makes the application process very specific. The elements we look for are things you'll typically see in a business model. So, we remove the business plan requirement because much of that information will be redundant once you've completed this checklist. And also from an internal perspective, it allows us to, recognize those key elements of the transaction a bit more speedy. So, so far, it's been received well. After we introduced the process, I believe the first one was completed within 2 weeks. Sorry, it was not completed within 2 weeks. Within 2 weeks, and we completed it in 3 days, as mentioned. And so far, it's been working well. We know particularly Q4 gets a bit busy from registrations, and certainly in the ILS space. So we anticipate a few more coming in before the end of the year. And hopefully this can be, benefit to those looking to set up for the Gen 1 renewal period. So yeah, it's pretty much leveraging the expertise we have in-house and the experience we've had over the years, and also creating efficiencies within our own processes, and also producing a framework to the market that can be beneficial for these typically upfront, ready-to-do business platforms.
Yeah, I would just add to what Tejan's saying, as someone who's on the ground and has to deal with the regulator all the time, the BMA making everything clear and expediting the process is very helpful. It introduces significant less execution risk on the transactions, and that's a huge asset to the cedents, the investors, everyone involved. As Tejan said, a lot of time and effort goes into executing cat bond deals. They're not cheap, and anything to reduce the execution risk on the transaction is a welcomed endeavor for everybody involved.
No, that's fantastic. I mean, 3-day turnaround time guaranteed. You really can't beat that. I mean, I thought the 5 days was putting us ahead of the curve, but I think the initiative is excellent. Turning then, maybe we've looked back and we've looked at where we are currently. What's the longer term view of the ILS space for regulatory oversight? And again, Tejan, sticking with yourself to kick off.
Yeah. So as mentioned, we've had quite a bit of wholesale changes over the last 3 years. So any further major changes right now sort of are not priority. The main focus and priority is really embedding the changes we've made, getting the message out there, ensuring that stakeholders are aware of how things operate between the various classes, the standards that are spelled out in the special purpose insurer guidance note, and also some supplemental guidance for the collateralized insurer class. So that's the priority as it stands right now. I think in addition to that, we see some potential for efficiencies. If you think of the supervisory process and ILS in the broader context and what exists in Bermuda. So there's a great presence, not only from the insurance side, but the fund side, insurance managers, insurance funds that are dedicated to ILS platforms. So there's opportunity to, create some supervisory efficiencies among, those registers, which are all supervised by the authority. So that's one area that, in the future, there could potentially be some efficiencies built in addition to sort of the supervisory metrics, how companies interact with the BMA. There could also be a bit more efficiencies there. So take, for example, back the Threeday cat bond. Right now, currently, the checklist is filled out, it's submitted electronically, large in part because of the COVID environment we live in. But, it's still a bit manual. So introducing a further platform where the information is, put up on the platform and the interaction from the authority comes via the platform. So it's fully electronic and automated to an extent where it's appropriate. Those are other opportunities that could potentially be in the long term. That's just one example, but certainly as, the world embraces technology a bit more, technological advances is one area that the ILS market could potentially see, improvements from the regulatory framework. But once again, just reiterating, the BMA is looking to be in step as much as possible with the evolutions in the market and, the insurance and insurtech world as much as possible. So it's very hard to say, what it will be, but we do have our sights on a future in sort of the ILS market.
I'm going to hand it over to Nick, but it's very heartening for me to hear you talk about ILS funds as well, because obviously it's very close to my heart and it's kind of matches up from both sides. Nick, maybe did you want to add anything for Tejan's comments?
It's good news to hear that the regulator's looking to digitize and enhance that side of things. It's not just the alternative risk transfer space that needs that sort of enhancement. It's the whole regime as a whole. That's certainly something that can be done a lot more efficiently. And just to iterate something Martin said earlier about fit for purpose, another way to say that is proportional. The BMA has always done that and continues to do that, and that will always be a key aspect of the Bermuda market. It's multi-class system and proportionality, and that I'm sure will continue to evolve as the space evolves.
Sarah, I think I left out one more comment, but there's a big topical issue around ESG, which I know, you served on the panel earlier this week. So we have an ESG working group, and we do expect that, that will filter down to the ILS space, what that looks like and how it's deployed. We don't necessarily have that visual as of yet, but considering the elements of ESG and even how topical it is within the specific ILS market, it definitely will be some, prudency for us to introduce some ESG measures within the ILS market.
Excellent. Martin, maybe if you can pick up from that, but also kind of see where the future's going from the investor side. Are you seeing different entrants wanting to come in? What's your view for the future on that side of things?
Yeah, absolutely. And, I echo the other's comments. I'm very positive about Bermuda on the regulatory front because it has that collaborative process and fit for purpose. And I mean, you work in large global groups, you work with regulators around the world, and not every regulator has that kind of collaborative approach where you try to get to build the right model that works for both sides. Looking ahead, I think, I know you made the comment on the ILS funds as well. I think the investors, as they become more educated, they have become comfortable with kind of this diversifying uncorrelated kind of insurance risk premium. And we've already seen them expand into non-property catastrophe lines, both ourselves and the market generally. So I think we're going to see more of that, be it cyber, be it specialty, be it casualty risks. And I think what we'll also see more of is non-traditional collateral, because a lot of these investors, they come from that pension fund, they're large asset gatherers, and they have a lot of collateral they can use to post. That's not necessarily cash collateral. So I think there's going to be a continued kind of convergence between the kind of asset risk and insurance risk. And also on your point, and even a compressing of when you see the ILS funds kind of sit on top of the insurance risk. So, I do hope I think the BMA has done a great job on the insurance side. And I think it's also important going forward to get that global recognition on the fund side too, as we look to distribute products or market products, be it in Europe or Eastern Asia, Australia, or, around the world, that you do get that global recognition for the regulator on that side as well.
Thank you. Nick, sticking with the future, was there anything else you wanted to add?
I would just add my hope, and this has been mentioned by a lot of third-party capital that's out there, but you want to see the ILS market covering more and more developing markets, because this is where the protection gap is most acutely felt. So, we've all got a role to play in this, from insurers, reinsurers, brokers, modelers. The more risks we can bring to the table, the more these third-party capital providers can cover. And yeah, hopefully we'll be providing that protection to those who need it most. And I think with the increasing focus on ESG and climate change, I think this will be a natural occurrence sooner rather than later.
It sounds like we've still got, we've come a long way, but there's still a long way to go, and we're in a very good place. So it's all very positive. I'm looking at the time. We're coming up towards the end of our presentation. I know I can throw some more questions at you. Is there any final comments before we see if there's any questions that have come in? If not, I will.
There may be one comment, because I think I meandered on one of your questions earlier and kind of answered something I'll follow up from Tejan. So you'd asked really about the collateralized space in Bermuda. So I would just, note, doing business in Bermuda is just so straightforward when you have, both the largest like ILS managers, the reinsurers, some very sophisticated service providers, be it on the fund administration space or the legal space, and the manager space. So I think hopefully it goes without saying for most of the audience, but in a very small place where you have the brokers coming and all the participants, I think we're all very bullish on where Bermuda sits, and hopefully continues to grow to kind of stay a leader in the space here.
Yeah, and maybe also just to add what Martin was saying there, I mean, I mentioned earlier about the outstanding capital in the cat bond space, but that's doubles when you talk about just the traditional collateralized space. There's about, AM Best said the other day that there's 50 billion of capital out there for just collateralized placements. So this doesn't include cat bonds. And again, one of the benefits of doing business in Bermuda when it comes to collateralized transactions is that you can very expeditiously execute on one of those. If you're using various sell vehicles, you don't need regulatory approval. You just need to hold a board meeting to set up a sell, execute a transaction. You only need basically 3 fundamental agreements: the reinsurance agreement, trust agreement, and the funding agreement. And in some domiciles, you can't do that that expeditiously. And there's a big difference between a collateralized placement and a cat bond. A cat bond, you're upwards, near 100 documents and agreements to facilitate one of those transactions, and they're costing you in the millions. But they are very substantial, covering hundreds of millions, where collateralized placements can be for as little as $1 million. So there's a lot of flexibility and efficiencies, facilitating those types of transactions in a market like Bermuda.
And you raised a good point. You talked about the cell vehicles and how it's very simple to set up a new cell. It's just a board resolution. You don't need regulatory approval. But in the spirit of innovation, Bermuda has come up with the new ISAC, the Incorporated Segregated Accounts Company. I don't know if you have any thoughts on that. I'm happy to tell the audience, well, let me say, it's the same as a segregated accounts company. So you have statutory firewalling from each account. The assets of one are not available to meet the liabilities of another. But each one under this new regime has a separate legal personality. So it means that each account has its own certificate of registration, which for counterparties is helpful. You can have different licensing within the same vehicle. So for instance, you could have an ILS fund and an SPI hybrid and have efficiencies there. I'm excited about it. I know we're talking a lot because it offers a lot of flexibility. You could also, arguably have a restricted SPI with an unrestricted SPI in the same vehicle. I don't know if Tejan or Nick, or Martin, do you have any comments on the ISAC?
I was just going to say, I think from, an ILS perspective, it certainly provides, the opportunity for that hybrid model, as ILS, is the convergence of the fund side, the insurer side, then you have the insurance manager, fund manager. So from the ILS perspective, we've certainly seen interest where they want to utilize that hybrid model. The ISAC regime itself is broader than, just ILS, but there's some key synergies that ILS has, kicked off of the ISAC regime, as was expected, and as we expect to, continue further. Certainly from an ILS supervisory standpoint, we do have a bit more work to do to, increase the awareness and knowledge of this particular space, and, how it can be utilized for ILS registrants and potential registrants. But there's certainly a strong interest, and really that hybrid model stands out when you think of the ILS product itself.
Yeah, I'd echo Sarah your comments. That I think it is a very good addition. While the current process, segregated accounts, works very well when you're dealing with, investors from overseas whose legal counsel is doing diligence and they're trying to get comfortable with it, by being able to incorporate a segregated account, in addition to being able to do more items within it, also can provide just comfort, depending where that other party is coming from and just what they're used to seeing. And it just helps us, again, kind of just expand that product offering, and kind of elevate, what's available.
Perfect.
Yeah, I had a quick question for Martin, if you don't mind.
Yeah, go for it.
So Martin, from the investor side of things, let's just say, for argument's sake, if the BSX or the BMA tagged a vehicle, or in the BSX's case is a note, with an ESG accreditation, do you think that would enhance the capital flows into the space, or might be warranted by the capital providers in the space? Or do the capital providers basically just do their own evaluation for what is ESG?
Yeah, I'd have to say I'm not an expert on ESG. I think generally, given what ILS or what reinsurance does in terms of providing capital after an event and letting kind of communities rebuild, or allowing people to diversify, some of the risk away to continue growth, I think it does fit naturally to a certain extent. There are offerings out there, but it's such a broad topic, ESG, in terms of, what does it mean? And as an example, it gets right down to the collateral. We've got collateral invested in ESG integrated funds, but, as you peel back the layers, you go, what does that mean? And it means there's a restriction list on what entities they may invest or buy bonds of. But then it gets down to a subjective view by that asset manager. So it's a very broad area. I think, there's a lot more regulation coming out in terms of how companies have to report, both in Europe and on the US side. And as ever, as we have our ESG reports on our company website, But I definitely see it's something that's going to expand over the next few years. I'm excited to hear that the BMA has an initiative. I think there's definitely appetite. So I think all asset managers are asking us to fill out ESG questionnaires, but the range is so varied from one to the other. Just because what does ESG mean to one person versus another is, in my own personal opinion, it's hard. That's a hard item to answer, because Facebook could be ESG friendly for one group, and it could be ESG unfriendly for another group, depending on your viewpoint.
Yeah. And I think as we, consider ESG in the early stages, Martin, you've hit it on the head. It's quite a bit of considerations. So it's certainly something that takes some time and thinking about. But no doubt, Nick, I think, from the sentiments we've heard in the market, ESG has become very topical, particularly for ILS.
Yeah, and I would just add, I think you need to break it down between, the three different factors, especially when you think about property cat, and there's a climate change component, but then there's also the your governance and how you operate. So it's definitely very wide ranging, but I do see there's going to be a lot of growth in this space, and a lot of people are spending a lot of time on it.
Yeah, that's why I kind of just wonder if as a market, if the BSX or the BMA awarded certain ESG based on their own metrics, if that might help, or if it's the job of the person investing to just continue to do their own self-evaluation.
I would think, I think there's already out of Europe and US, companies are having to report. I think most investors are going to, from what we've seen, they'll make their own determination. So it's more how you can, what do they think is suitable for them? And I think that's often very kind of investor specific. Just as an example, you could have an investor from the Middle East having some certain views on what type of products they can invest in versus another investor. But it is going to be very interesting to see how it develops over the next, 2 to 3 years.
And I think that's, a topic for a whole other webinar, as we've had on either side of this, and Bermuda's definitely in the mix, so it's great. One more question, if I may, before we wrap it up. Without Tejan focusing on any specific licensees, for the 3A, 3B insurers, so the smaller commercial, do you have any commentary on what they're doing in the collateralized sector?
So once again, this is really that those larger business models that have, a robust forward-looking appetite for, the business they want to conduct, the types of business they want to cover, the time of the business, 1 to 5 years, potentially even longer. So there's definitely the element of the future looking business model. And then also there are some that choose the commercial class to enhance what they're able to offer their clients, because collateralized business doesn't always meet the need of every client. So having that flexibility and that ability to offer a balance sheet is something that, some clients want to have readily available, potentially to supplement what they're doing in the collateralized base, fully service a client. And then I guess the other element is, we've seen a few collateralized insurers look for ratings and becoming rated collateralized insurers. So definitely that framework sits well with those ambitions.
Excellent. Well, I think we're coming up on our allotted time. So panelists, thank you very much. It's been a pleasure. Audience, thank you for sticking with us. And unless anyone has any final comments, I'm going to hand it back to Justin from RIMS for a brief closing message. Thank you, everybody.
Thank you.
All right. I'd like to thank Tejan Talbot, Martin Burke, Nicholas Plianthos, and our wonderful moderator, Sarah Demerling, for their time and expertise. A copy of this webinar will be archived on rims.org within a few business days. Visit rims.org/webinars to register for other upcoming sessions. Also, you can register now for the RIMS Canada Conference 2021, which will be held virtually October 5th and 6th. Go to rimscanadaconference.ca. Be sure to check out RIMScast. That is the Society's official free and weekly podcast. It is hosted by yours truly. Visit rims.org/RIMScast to subscribe and download. Finally, RIMS is global, and we'd love for you to join us. 10,000 of your peers in more than 60 countries are part of the RIMS community. This is a great time to build your network with us. Visit rims.org/membership to apply for a RIMS membership. Thank you all, and stay safe.